a diversified bond portfolio and a diversified stock portfolio, they play really well together. I mean, it's a simple way to accomplish it, right? I mean, tequila, lime juice, and simple syrup play really well together, right? Like, don't complicate it. I mean, you want to think about it like that, right? There are these time-tested things that can help you accomplish what you're trying to do. And, I mean, do you really need to make it more complex?
David Booth, our co-founder and chairman, I think he has a great line where he says, usually complexity does not add value. And it kind of goes back to what you're saying there with your margarita. You got a great mix. Don't mess it up.
Don't mess with it.
I think it's already too complex once you add the lime and the simple syrup. I guess in that scenario, I'm a 100% equity investor.
Here.
Welcome to The Informed Investor, where we break down the latest financial headlines, bringing in research and insights to help you separate the news from the noise.
A portfolio of 60% stocks and 40% bonds. Does it still make sense? That is our topic on The Informed Investor. I'm Mark Gochner, joined today by Jake DeKinder and Wes Creel. Guys, this is something that has been hammered for 20 years or so. Is 60-40, and there's always better solutions. So let's do this. Let's start with some headlines, come to you guys, and we'll get some thoughts. I'm going to start with some negative headlines on the 60-40. I'm going to start with my favorite. You ready? The 60-40 portfolio is on life support. 4 new ideas from top managers. Another one. Why investors can no longer count on the 60-40 portfolio. All right, now let's go to a positive one. And this one is the classic 60-40 strategy makes sense for investors again. And by the way, the positive one came 3 months after the one I just read.
Of course it did.
Make sense.
Yeah.
Right. All right. So quick take on some of those headlines. Jake, I'll start with you.
Love the life support comment there, right? And then think about the second half of that of 4 managers come out with new ideas that they want to sell you products around. Of course they're going to say the 60-40s did because this industry is built on packaging some stuff up and selling products and pushing it out to customers, really, not even investors there. So that one doesn't surprise me one bit.
Hey, careful, that proliferation of products keeps this podcast in business, so we should be happy about that.
If it was just 60-40, buy and hold works, we'd be dead. We'd be cut after 2 episodes.
Just hit repeat.
But to your point, though, I mean, this has been going on certainly since we started Dimensional, probably as long as the 60-40 has been around. It's been taking slings and arrows. And I think, as you guys are alluding to, a lot of this is correlated with the launch of new products that are going to fix whatever just went wrong with the 60-40.
You get a little bit angry after you do this for a while and a little bit exhausted by it. I mean, how many year after year, it's here's the new shiny object, here's the thing that's coming out, focus on this thing.
I feel like Michael Clark Duncan in the Green Mile. Sometimes I'm just like, I'm tired, boss.
That's what you do feel.
Well, we get paid, though, right? It keeps us employed here.
It's true.
So.
Sure.
All right. Do you have some history, Wes? If you go back, how did the 60-40 sort of come about and become such a popular idea when it comes to asset allocation?
Yeah, I did my best to do sort of a historical deep dive on this. If you just search for the origins of this, you might get 10 different answers at 10 different website hits. But it does seem to trace its origins back to a mean variance exercise where you're going through this process of, I have 2 asset classes. What is the optimal combination of those 2 that gives me the highest return per unit of volatility? That was the spirit behind mean variance optimization. And apparently it did land on a combination which is 60% stocks and 40% bonds. Now, that doesn't mean everyone should have that. Number one, that's a noisy exercise. That doesn't imply that whatever happened in the past is going to give you the best return per unit of volatility in the future. It also doesn't mean that everyone has the same objectives, right? So this is for someone who is looking to maximize their return per unit of volatility. Not everyone's trying to do that. Some people actually want to manage their volatility more specifically. People going into retirement, maybe they want to lean more into fixed income to further reduce that overall volatility, even if it means giving up some return. So that seems to be a big part of the origin of 60-40.
It's a good point there that it's going to change through time with people, right? Depending on how their risk tolerance, their needs, their liquidity, their age, all of those things change. I think about 60-40 a little bit more as a concept than it has to be a precise 60-40. It's to say, listen, you've got broadly diversified stock market, you've got broadly diversified bond market. Can you put elements of those together in some allocation and be real simple on how you move through your financial life? 60-40, 55-45, 50, I don't really care, right? It's when you start adding additional complexity that I think you can get yourself into trouble.
Yeah, and A little bit of fixed income drastically reduces the level of volatility of the portfolio. I mean, it's very clear historically what the benefit has been of 60-40. You know, if you look at a globally diversified stock and bond mix going from 100% equities down to 60-40, your return doesn't get sacrificed too much, go from 9.9% down to 8.6%, but your volatility drops really substantially. Your worst calendar year goes from about minus 40% for the global stock market to a little bit over minus 20%. So very substantial reduction in the drawdown risk. So you can really see the appeal here.
Well, I look at what's the goal of each one of those components, stocks versus bonds. And of course, the stock part's, I'll say, fairly easy. That's just, I want to grow my portfolio, grow my wealth over time. The bonds, to me, gets a little more complex because it can serve a variety of different purposes, right?
That's right.
It could be stability. Hey, I want safety. I got something I have to buy in a couple of years. It could be, I do want some higher returns from my bonds. So maybe take on a little more credit risk, maybe a little more term maturity. But it also could be inflation concerns you got to protect against. It could be some tax sensitivity. So it does get complex on the bond side. It's not as simple as just to say, 40% in bonds and I'm done.
I think about it like my golf bag. And Kim Kaiser, our producer, told us we weren't allowed to talk about golf. So, Kim, I'm sorry. We're breaking the rules today.
Overruled.
This was back like episodes like 2, 3, and 4. She's like, yeah, you got to stop talking about golf too much. But I'm serious. I think about it like that. And it's a good point you bring up. Think about equities, right? Long-term growth. That's like your driver and your 3-wood, right? They serve one purpose, which is crush it down the middle of the fairway.
Mine don't go to the middle of the fairway, unfortunately.
I said that's the goal, right? But your fixed income's like your 3-iron through your putter. They play a lot of different roles in your golf bag and your golf game, and they play a lot of different roles in your allocation when you think about fixed income. Capital preservation, total return, inflation protection, tax sensitivity. And so I love having that fixed income component in there because we say 40%, but there's a lot of nuances to that 40%.
By the way, I love your pen. I don't see any paper or notes, but it's all right.
Oh, it's
here.
a total security blanket, right? You ever see that 30 Rock with Alec Baldwin? He's like, I don't know what to do with my hands.
Yeah, lemon. All right, I want to go back to another reason I think he gets beat on, and this is more recent. And you go back to 2022, which was a pretty tough year for bonds. And so I ran a couple of numbers here. And for this one, I looked at the stock market, the Russell 3000, which I think started in 1979. So that's where I'm going to start some of this data. And then the Bloomberg U.S. Ag, which is kind of a proxy for the U.S. Bond market. And I go back to the ag side, the bond side of those things. And so if you look at the last 47 years, where we have the data for that, there were 5 negative years in the bond side, which is about 10% of the time or so. Now, I'm going to poll the audience here. I'm going to quiz the audience. What was the worst year we had in those 47 years? And it was 2022, right? Where everyone's talking about how 60-40 makes no sense because bonds happen to be negative when stocks were negative. The second poll for the audience would be, how many times in those years, 47 years, did the ag have a negative return when stocks had a negative return? One time in 2022. So it just didn't happen to work that one year. So everyone just starts giving up on it and saying, hey, there's got to be better ways, better solutions out there. So I think that sort of dovetails with your comment of, hey, there's all this product out there, this shiny new product that you can go out there and sell as well.
That's the very definition of an outlier. And you don't necessarily want to rejigger everything you're doing in your portfolio based on an outlier. You might prepare around that. That's why we did that episode on the fire drills. So, you have adequate preparation in your asset allocation.
Well, I'm going to mention on your outlier comment. So just going back to the ag side of things, in 2022, the ag was down 13%. And the next worst year was 1994, where it was down 2.9%. So that really was an outlier year, right? And we talk about this, Jake. There's always a first for something. There's a first to have the worst return we've seen in the ag.
Well, also risk and return are related, right? I mean, you think about bonds, and people would probably say less risky, less volatile, plays a different role. And for the most part, it does, right? It doesn't mean it's a riskless investment, right? Like you still had interest rate risk, you still had inflation risk, you still had things. You had things that could potentially impact the return of your bond portfolio, and that's what you got in 2022. That's part of the deal.
Seems like a lot of times when people are throwing dirt on the 60-40, it's because something has gone wrong in markets or they've had some sort of turbulent experience. Like you go back to the GFC or the global financial crisis, where because of all that stock market volatility, people were saying, well, the 60-40 has too much of its volatility coming from the equity side. Well, you should be equilibrating that, so have equal contributions to your volatility coming from each side. This gave rise to this whole new set of investments called risk parity, where you balance the risk between them. More recently, people said, well, the fixed income is not adequate to balance your risk, so you need these buffered ETFs. Didn't we do a whole show on buffered ETFs? I think that is a good sort of lesson for investors to keep in mind is every time people say 60-40 is dead, the question is, what are you going to do about it? Well, if it means you're going to start investing in new products that might have more complexity, less transparency, higher fees, then it's not totally clear you've replaced something with a better alternative.
A lot of investments are going to tie back to the stock market and the bond market, right? You can package it up, you can slice and dice it, you can pull in derivatives, you can do a bunch of stuff in there, but the underlying exposure is what you have to ask yourself, what are you getting? I mean, it reminds me a little bit of the value premium, right? I mean, how many times has the value premium been rediscovered in a different way? But is that actually the most efficient way to get exposure to the value premium?
This kind of brings back some of the other stories that are grinding my gears, which is another reason to be suspicious of the 60-40 portfolio is because correlations have been rising between stocks and bonds. We hear that one all the time. I think that ignores the fact that a lot of the reason why correlations rise in periods of market volatility is because that's when the systematic component, the thing that drives prices across asset classes, was very volatile. And so that's when your correlations are going to look like they're higher. But just more specifically to correlations in general, we had an exercise where we looked at the rolling correlations between U.S. stocks and U.S. bonds over time, very long sample period, and then looked at what is the diversification benefit over these same periods, which we define as the percent of variance reduction you get by adding the bonds to the stocks. So we have correlations going up and down like this. The actual reduction in variance was like dead flat through time.
Listen, a diversified bond portfolio and a diversified stock portfolio, they play really well together. I mean, it's a simple way to accomplish it, right? I mean, tequila, lime juice, and simple syrup play really well together, right? Like, don't complicate it. I mean, you want to think about it like that, right? There are these time-tested things that can help you accomplish what you're trying to do. And, I mean, do you really need to make it more complex?
David Booth, our co-founder and chairman, I think he has a great line where he says, usually complexity does not add value. And it kind of goes back to what you're saying there with your margarita. You got a great mix. Don't mess it up.
Don't mess with it.
I think it's already too complex once you add the lime and the simple syrup. I guess in that scenario, I'm a 100% equity investor.
We won't talk about your extracurricular activities on this.
Yeah. We've alluded to that before.
All right, but I go back to this idea of a time period where maybe something doesn't work, and do you just give up on it? I'm going to talk about something, even happening this year where, we got a family ski trip coming up in February. And this is one of the worst years we've had in
It's been a rough year
number of
for
years when it comes to snow. And shoot, we'll even see if there's snow out there, what it looks like here in a couple weeks. But it doesn't mean that all of a sudden I go, okay, skiing's the worst. I hate it. We're done as a family skiing. It just means, we had a bad draw this year, and we'll come give it a shot again next year, right? And odds are it's going to be a much better experience than we had this year.
No, it's a great point. There's outliers, right? It doesn't mean you're not going to go back to next year, 2022. It's an outlier. That happens with investing. We've said this multiple times on this show of expect the unexpected. And if you want to invest for the next 30 or 40 years, you're going to encounter it's different, it's a first, it's the largest, it's the biggest. Just get ready for it.
All right, so what do we know that puts the odds in our favor as an investor? And it's kind of those things you got to focus on. You got to keep your costs down. It's not just the expense ratio, but also how a portfolio is managed. You want to keep costs down, turnover low, things like that. You want to make sure you're diversified. Make sure it's transparent. You got to know exactly what you're getting into. Can I get my money out? Liquidity, when, and how does that work? So those are all the things you can control, you want to be informed about. Whenever something's getting positioned, like, hey, here's an alternative to a 60-40, just be able to answer all those different questions, right? And then, of course, the financial plan is always really helpful. And Jake, to your point, it doesn't necessarily mean it's got to be 60-40. It could be 70-30, 55-45, those kind of combinations. But built into that plan is on expectation, you're going to have some tough years. And so when you have those tough years, it's okay because it's built into the plan. So that's kind of how I think about a summary of the 60-40. Anything you guys would add to that?
You go back to 2022, and we all had these conversations. You go out and you talk with financial professionals, you talk with financial advisors, and don't get me wrong, I'm not trying to shortchange 2022. Your stocks are down, your bonds are down, you look at your statement, oof, that hurts in December. I hear you, right? But you ask these advisors, like, hey, did your clients really change up the way they were living their lives, right? Did they have to make drastic changes to where they lived, how they were spending, the trips that they were on? And for the most part, they would say, yeah, it was kind of painful, but everybody kind of kept going. So I think you get this outlier year, but to your point, if you've got a good plan in place, you've built it for that. And now we're several years removed for that. People are back on. Equities have been good. Bonds have kind of returned to it. So, deep breath. I hear you, but deep breath.
Yeah, I think you want to be careful when you have something that looks like a replacement for 60-40, ends up replicating a lot of the characteristics of the 60-40. One of my graduate school professors used to say it's okay to reinvent the wheel, but don't reinvent the flat tire. And I think that's what people are in danger of when they come after these shiny objects that look like a better solution than 60-40.
Boom.
All right, he has the best one-liners. We're going to get our coffee mugs and T-shirts. Don't invent the flat tire. All right, everybody. Hey, thank you for joining the Informed Investor today. We're going to come back on a future episode and talk a little bit about emerging markets. Had a great year last year. We're getting questions on how and where it fits into our portfolio. And be sure to check out the questionnaire. It gives you a chance to submit topics that we can consider for a future episode. So we always love to hear what's on your mind. So thanks again for joining us. Have an awesome rest of the day. Take care.